The anticipation surrounding Friday's jobs report has reached a fever pitch, with Wall Street and investors anxiously awaiting what could be a pivotal moment for the U.S. economy. But here's where it gets controversial. New data released on Wednesday confirmed that job openings have plummeted to their lowest levels in nearly a year, signaling that hiring momentum may be losing steam faster than expected. This revelation comes from the JOLTS survey, a key barometer of labor market health, revealing that the number of available positions dropped sharply in July to 7.18 million, down from June's downwardly revised figure of 7.36 million. Not only did this miss consensus forecasts, but it also painted a concerning picture of an economy grappling with growing uncertainty. The implications of this decline are far-reaching. For one, the job openings rate fell to 4.3%, reflecting businesses' hesitancy to expand their workforce amid signs of economic turbulence. Certain sectors have been hit harder than others. Healthcare, arts and recreation, and mining industries saw significant reductions in available roles. Regionally, the South and Northeast experienced notable declines, underscoring how uneven the slowdown has been across the country. And this is the part most people miss. While some might dismiss these numbers as temporary blips, they align with broader trends suggesting structural challenges within the labor market. As Friday approaches, all eyes remain fixed on the upcoming employment update, which will serve as a critical determinant for Federal Reserve policy decisions and investor sentiment. Earlier this week, analysts at Bank of America warned that the U.S. labor market is showing unmistakable signs of deceleration. They attribute much of this slowdown to supply-side issues, including tightened immigration policies, which have constrained the pool of available workers. Since earlier this year, these factors have contributed to modest increases in unemployment rates, adding another layer of complexity to the economic narrative. Meanwhile, financial markets are already reacting nervously to the shifting landscape. Stocks dipped sharply on Tuesday following the Labor Day holiday, marking a shaky start to September trading. The unease spilled over into global bond markets on Wednesday morning, with a notable sell-off occurring just ahead of the JOLTS release. Investors seeking refuge from volatility turned to gold, driving its price to record highs. According to UBS, September historically ranks as one of the weakest months for equities, particularly for the S&P 500, which has averaged losses of around -2% during this period over the past decade. In 6 out of those 10 years, the index ended lower, reinforcing fears about potential turbulence ahead. In its latest global economic outlook, Bank of America reiterated its projection of a mild stagflationary environment persisting through the remainder of 2025. While demand hasn't collapsed entirely, the bank argues that labor market softness primarily stems from supply shocks rather than weakening consumer appetite. The U.S. labor market is slowing down, the report states, emphasizing that this trend is largely driven by supply-side dynamics rather than faltering demand. Recent revisions to payroll data further underscore this point, revealing that average monthly job gains now lag behind pre-pandemic norms. Looking ahead, Bank of America predicts the unemployment rate will gradually climb, settling between 4.2% and 4.4% in the coming quarters. This makes the labor sector a focal point of concern moving forward. But the stakes extend beyond just the jobs numbers themselves. The Federal Reserve faces mounting pressure to strike a delicate balance between addressing inflation and supporting economic growth. If policymakers misjudge the situation and cut interest rates prematurely, they risk exacerbating inflationary pressures in a stalling labor market. Such a misstep could amplify financial volatility, especially if Friday's jobs report falls short of expectations. Historically, it's rare for the Fed to reduce rates when inflation remains elevated, and doing so last occurred shortly before the 2008 financial crisis, a parallel that raises eyebrows among economists today. Adding fuel to the debate, Torsten Slok, chief economist at Apollo Global Management, recently floated the idea of an impending inflation mountain. Drawing comparisons to the inflationary spikes of the early 1980s, Sloak highlighted several red flags in current economic indicators. For instance, surveys show an increasing number of small businesses reporting poor sales, a harbinger of rising unemployment in the near future. Similarly, deteriorating consumer confidence about the labor market suggests that job growth is likely to slow even further. Based on these patterns, Sloak anticipates Friday's report could come in below the consensus estimate of 90,000 new jobs added. In summary, the July JOLTS data confirms what many analysts have feared. The labor market is cooling off more rapidly than anticipated. As markets brace for Friday's pivotal jobs figures, the question remains whether this trend represents a temporary hiccup or the beginning of a prolonged downturn. Will the Fed act cautiously, or will external pressures force them into a premature rate cut? What do you think? Could we be heading toward a perfect storm of stagflation and stagnation? Or is there still room for optimism? Share your thoughts in the comments below. For this analysis, Fortune utilized generative AI to assist with drafting initial content, ensuring accuracy and clarity throughout the process. A team of editors meticulously reviewed the information prior to publication. Mark your calendars. The Fortune Global Forum returns October 26 to 27, 2025 in Riyadh. This exclusive invitation-only event will bring together CEOs and global leaders to shape the future of business. Apply for your invitation today.